Ladies and gentlemen, traders of all ages, and all you investors out there, this is my deep dive course on candlesticks, which are now the most popular chart in financial markets. So I think it makes sense that you learn how to read them, use them, and at least know what other people are doing with them. So kick your feet up, get comfortable, let's dive in. Now, candlestick charts matter because of all of these reasons that you'll see here. They are data rich, they provide trading ranges, they can showcase some volatility or give you some historical background about such volatility. And then, of course, with knowing the trading range and volatility, you can start to set your expectations. This is really important. I'm going to get into this in a few slides. Setting your expectations is everything in markets. Before you ever place a trade, before you ever buy and hold something, you need to know what you're getting into. And candlesticks can give you some insights into that, which I'm going to show you. And that's why if you're a long-term investor watching this presentation, I think you're going to see a lot of value in this about setting your expectations by using candlesticks to gauge a trading range and to see what the volatility might look like out into the future. Also, if you're a technical trader, candlesticks are essential to chart patterns. They demonstrate sentiment, and you'll see a lot of videos online about supply and demand. I don't necessarily think candlesticks are that great at showing supply and demand, but I'm going to cover it because you've probably seen tons of videos about people talking about supply and demand. So I'm going to give some insight into that, the good and the bad, of course. But that is the key to why candlesticks matter. Now, I believe any good educational presentation needs to always remind people about the negative or why this may not matter at all, sort of the counter arguments. You'll find that a lot of videos about candlesticks on the web never do this. They're just a get-rich-quick scheme of sorts, and that to me irritates me. It's why I'm making this video. I'm trying to bring something a little more useful and straightforward to everyone out there who's curious about the subject. In fact, you can even see here why they don't matter is it's potentially just another thing to sell, meaning there are people out there who are selling some sort of candlestick course. I can make you money 100% of the time, they might say, by following these candlestick patterns. That's just not true. There's no such thing as anyone who wins all the time. And that does bring me to the first point of this slide, actually, which is pretty important, which is show me a rich candlestick trader. So if you can think of a rich candlestick trader, go to the comments below and write it out. But I want to say on that note, most of the famous investors out there, like Warren Buffett, probably never use candlesticks. At the same time, that does not mean candlesticks don't matter. I'm going to tell you why. As mentioned, I manage my own account, but what's really important here is that I have to use every tool I have because unlike Buffett, I don't have billions of dollars to hire research teams, to pay them enormous salaries, to make phone calls, do meetings, go through investor reports. I need to use what I have at my disposal, and one of those tools is candlesticks. Candlesticks, after all, show me the high, the low, the open, the close, instantaneously. So while some might say, show me a rich candlestick trader, maybe there's not many out there, for us small-time traders, it gives us a little bit more to work with. I don't think I'm ever going to trade my way to $1 billion, but I do think that by using some of the things I've learned over all the years, I can sustain a strong account over a long period of time to do pretty well for myself. Now, another aspect of why candlesticks don't matter is that there are a lot of fake traders out there. For me, TikTok is horrendous. There are so many fake traders on TikTok using candlesticks to act like professionals, to show fake trades, to show get-rich-quick schemes. And that might be why candlesticks also don't matter, is they're just too noisy and it's just too sort of euphoric out there. There's no way they can work. And that does take me to these final 3 points about why candlesticks don't matter, the mega counter argument of this video, which is that at this point they're exploited and or markets are random, or after all, markets are run by people, people are doing the trading, candlesticks are just a reflection of that, you just can't read it, it's too random, it's too noisy. But I do want to talk about the exploited in all markets aspect really quick, which is that if I was a professional trader, I would essentially watch all of the popular candlestick videos on the web and then make a trading system that takes the other side of those patterns and ideally just really do fantastic for myself, because after all, retail traders don't really have the capital or the strategy or the time. They might have a day job to sustain a trade for long periods of time. So you might just exploit them. Just make a strategy that does the opposite of what all of the sort of newbies are doing out there. To really demonstrate the power of candlestick charts, I think it makes sense to compare and contrast the two most popular chart types on planet Earth today. The two most popular chart types that you will always see across the web are candlestick charts. So this is a candlestick chart here, and line charts. This is a line chart here. So candlestick charts, line charts. Now, there are some really important differences between these two charts, and I have a live version prepared for you right here. So on this candlestick chart, you get 4 pieces of information in one quick view, and you also have color optimization as well. However, on the line chart, you get 1 data point and the same color across that line no matter what. So there's way less information on a line chart. Let me show that as an example. If we hover our mouse over this price right here, it says Tuesday, May 14th, 2024, the price of GameStop was $48 a share. Then we move our mouse to the next day. The price was $39 a share, and the next day, and the next day. Meaning on this daily chart, on this line chart, we are only seeing 1 price point for each day. Now this could be set to any time interval, hour, months, weeks, but the point is line charts show 1 price point. Candlestick charts show 4 price points, because if you recall, they show the high, they show the low, and they show the open and the close. They also show green or red depending on if the open was higher or lower than the close. So there is a ton of information to gather from a candlestick chart compared to a line chart. Here's an example. Remember, up here it says $48 a share, 1 price point. On the candlestick chart, we can actually see that the open, also it was the high point of the day, how interesting is that, was $64 a share. We can see the absolute low point was $35 a share, and we can see the close was $48 a share. Now, take a look at how important this is. We can see that the open was also the highest point of the day. And from that point, it just simply never went higher. In fact, it went straight down the rest of the day on this candle. And look what happened after that candle. It's probably safe to say that if the price of a symbol opens at its high and then keeps going down for the rest of that period, that means there were a whole lot more sellers than buyers. So it opened up here and through the whole day just kept going down. And it never even got close again to those opening highs. You simply cannot see that on the line chart. It just shows the price point. In this case, it was the close. And on many different charts, you can fact check that by looking at your line chart, seeing the price source, and it says close. So this just shows us the close on the day, whereas the candlestick chart shows us all of this information, plus the aspect that the candle's even red, so we can quickly see that the open was way above the close and it just went down throughout the day. So that is one of the more important aspects of candlestick charts, which is the level of information it shows you compared to a line chart. And once you understand this, you can really start to see the power of candlestick charts and where you may want to use them in your own investing and trading. I want to dive into the data-rich component of candlesticks a little bit more and teach all the new traders a new term. So as mentioned, candlesticks show 4 price points: the open, the high, the low, the close, or OHLC. So if you see OHLC around the web or elsewhere, now you know. OHLC means open, high, low, close. Those are the 4 data points that you can see on a candlestick chart that you just can't see on a line chart or other chart types in general. So moving on, this OHLC does give you a visual cue into all the things happening in markets. The price action, the buyers versus sellers, the ranges, the volatility, and of course the open, high, low, close in general. So we can really see that in a recent example at time of recording this video. Once again, GameStop mania, it just went bonkers the other day. And what's so interesting about candlesticks that you just can't see in a line chart is look at the consecutive green candles here. You don't see that on a line chart because you can see the ranges and it's colored green because it means that the open was higher than the close. And in addition, you can pair that with volume as well and really see that volume was rising here as well. So before this mania even happened, there was something brewing days, if not a few weeks before. And once the mania hits the mainstream, naturally, that's when the FOMO, fear of missing out, kicks in, the hype. That's generally when things don't go well, but the smarter traders, the people who knew something or were planning something or could see the action occurring, well, if you look at the candlesticks, they really tell you the story right here, and you can get that with the data-rich capability of candlesticks. And you can see here I even annotated the chart to make it a little more interesting from the standpoint of the different people who were involved in that trade. GameStop had been going down for a long time, so you could argue that these were all of the trapped traders. Right here, you can see these three candlesticks. Maybe someone smart was noticing something. Now, of course, the technicals are setting up. The candles are showing multiple green candles, volumes increasing. Perhaps this is where the smart traders with alerts, technicals, are starting to see what's going on. Then, of course, this is nothing but hype, and as mentioned, you generally want to be careful in those regions, but the candlesticks can prepare you for that and show that on a chart in a really vivid way. And if you study it enough, you'll really start to see what type of trading ranges you can expect in specific stocks that you just can't see on a line chart, or even get some insights into possible volatility, which, as a great example, we will go through in 1 second, but you can just see here the candlestick on GameStop should teach you that this can happen in the future, and you want to be prepared for some volatility like this, but the line chart just doesn't show that. See that? You're missing all of this price information, which is expected volatility that could come again in the future, and you want to make sure you're fully prepared for that. Now, I do want to dive into the trading range and volatility concept a little more, and why they're so important and how they make candlesticks as useful as they are. So here's an example of using candlesticks to measure a trading range. Now, remember, candlesticks show the open, high, low, close. They're data rich. They show all of this information that other charts like line charts don't. So if we measure the low, which is the bottom wick here, all the way up to the high, we get a feel for the trading range. Meaning, with the candlestick, we can see how low it got, how high it got, and then get a trading range. It went from here to here. That's $19, or that's 4%. Now we can start to set our expectations. So here's one green candle, 2, 3, 4, 5. And over these 5 green candles, I've put measurements here that measure the absolute low to the absolute high, low to high, low to high. And what we're doing, or what I'm doing, is I'm getting a feel for the range. So before I ever buy, sell, or trade this asset, I know that over a set period of time, I can set my expectations on what the range might be. And thus, if I were to make a trade and suddenly lose 4% or gain 4%, well, I know that's happened quite a bit. So the buyers and sellers have moved this up and down a set range over a set period of time. I'm going to take that information to set my expectations that that could happen again in the future, because it seems to be happening quite a bit between all of the buyers and sellers involved at that period of time. Now, this applies to volatility as well. What you're going to see on this chart, which is really, really important here, is we're looking at not only the ranges, but how chaotic is the most chaotic range. How massive are the ranges? If we look back in history, how many times does a very chaotic move occur? Now, we can use this chaotic information to once again set our expectations. So what we're doing here, because candlesticks show the open, high, low, and close, we are setting our expectations accordingly. We've used the candlestick to measure the range from the low to the high to get a feel for what the average is, what happens often in this asset, what should we expect in the future. But now we're also going back in time to find the most abnormal moves so that we can set our volatility expectations accordingly. So while a symbol might move rather calmly over a set period of time, if we zoom out far enough, we're going to see these large candlesticks. Here's one large candlestick. Here's another large candlestick. And now we can say, well, these large candlesticks seem to happen once every 2-3 years or so. Well, we better set our expectations accordingly that this is not out of the abnormal for this symbol to move like that. So if we buy here, we'd better be prepared for something in the future because it may as well happen again if it's already happened before. And that takes us to our expectations. You, with candlesticks, can find the trading range and to get some sense of volatility and thus set your expectations. This means you are preparing for what may come before you start trading. And by the way, this works for both types of traders and investors because this is where this gets very important with candlesticks. It's not just about making money or losing money. A lot of traders and investors sometimes think the market is a place to get rich quick, but what really happens is the market is rather boring. And by setting your expectations, by measuring the range and getting a sense of the most abnormal moves, well, now you know what to come in the future. What's to come in the future? Are there big swings or small swings? If you find that a symbol is really boring, there's no trading volume, the ranges are small, well, you should know if you're buying that. You might have a really boring ride ahead, but maybe that's what you want. Maybe you want low volatility, low range. You want a symbol that you believe in, has a trend, there's a trade there, and it just has shown that there's not that much action, so that's what you want to be in. It's maybe easier to manage. Or maybe you're a day trader, a swing trader, and you're looking for these mega moves. And with these mega moves, well, that fits your trading profile. That's what you want to see. So you are setting your expectations and preparing well into the future by measuring the trading ranges, by looking for abnormal moves to get a sense of volatility, then using those two pieces of information to plan ahead and set your expectations, but most importantly, using that information to align it with your style and who you are as an investor or trader. And this, after all, is where candlesticks, once again, can be a very valuable tool and how they're used. It's time to talk about one of the most important concepts in candlesticks, which is drawing on your chart, looking for levels to buy or sell or watch. So that could be support and resistance. Support meaning where are the buyers showing up. Resistance meaning where are the sellers showing up and how you draw that with candlesticks. It could be trend lines, looking for a trend line that's sort of guiding price higher, where the buyers showing up. Is the trend going up and to the right? Or drawing chart patterns awaiting breakouts or classical moves in technical analysis that seem to repeat over time. Candlesticks, after all, once again, show you the open, high, low, and close, and so they give you the information you need to draw on your chart to map out where the buyers and sellers are, or to plan accordingly, or to await the next big move based off of where you're drawing your lines. Now, I just said based off of where you draw your lines because this is where candlesticks can get complicated. You have the highs, right? Open, high, low, close, but you also have the opens and closes, which are the bodies of the candlesticks. That's where the fill-in starts, not necessarily the wicks. How are you going to draw your support and resistance lines on a candlestick chart? What's really important here is you have to go find what works for you. There is no secret sauce here. When using candlesticks to draw support and resistance or trend lines or chart patterns, it's really going to come down to what works for you. We all have different time horizons. We all have different account sizes. We trade different assets. We have different risk tolerance. How are you going to plan your trades with one of these tools while using candlesticks? I'm going to walk you through a few things you could think about while you're mapping that out. Now, this is a chart of gold, and what's so fascinating about this chart is you can see these wicks here at $2,000, and I've drawn this line across. So what this means is the absolute high here was about $2,000, and when price hit this level in 2000, it dropped. Then a few years later, that's right, people just sat around and waited. Price got there again, and what happened? It dropped. So you're using these wicks to see where the extreme selling is, where's the most selling occurring, and the bears are just taking over. Here's where things get fascinating. A few years later, it happened again, and guess what? Price dropped. But the story does not end there, because a few years later, it happened again, and then again. That means 4 different times, price hit this $2,000 level, actually 5 times, and not until the 5th time did it break out and the bulls won. It took them 4 years to breach this important wick here, this high of $2,000. 4 years. Now, you can use candlesticks to do this type of research to see where the buyers and sellers are. In this case, the sellers, and you can plan accordingly. What's so fascinating is that after 4 attempts, they finally did it right here, and look at the move. It has been a pretty impressive move for the bulls on gold, nearing $2,400, which is an all-time high for the price of gold. And this is how you can use candlesticks to draw your trend lines. You could look for the wicks, but remember, I'm going to show you some more here that might make you think a little more deeply about candlesticks, and sometimes having too much information might be a bad thing. So check this out. Here is a trend line. Now, we've all seen trend lines in markets. Something's going up and to the right. Buyers seem to show up as the trend line occurs. We are going to go to a chart of NVIDIA to see this exact trend line. And what you want to pay attention to here, and it applies to support and resistance as well, is where are you drawing your trend lines and what determines them. So this is a very interesting example. Every time NVIDIA has hit this trend line, it's just kept going up. Maybe someone is following this, a group of buyers, maybe the S&P 500 holds NVIDIA, perhaps they're allocating capital at each point on this trend. The whole point here, though, is this trend line has been drawn in a highly specific way. Similar to the previous chart, I've only connected this trend line to specific wicks. I've tried to avoid bodies at all costs. So this trend line shows the extreme wicks on each candle here, and each time it hits that trend line, price seems to pop back up. But this is my interpretation of the situation. You may want to draw your trend line a little differently. Perhaps you only want the bodies to connect. Of course, if you only have the bodies connecting, that changes things a little bit, as you can see, actually quite a bit. So you need to figure out whether you want to connect your support and resistance lines or your trend lines with wicks or with candle bodies. In addition, what is rather important here is that you must do the research yourself. So I have this note here. Find what works for you, whether it's support and resistance and where you want to draw those levels, or trend lines and where you want to draw those levels. And next up is chart patterns. By the way, on my YouTube channel, I have videos that cover support and resistance in detail. I also have videos that cover trend lines in detail and chart patterns in detail. Go check out those videos to learn more about this concept. But what I do want to show you now is this chart pattern I've prepared on Chipotle. So in this example, there's a bull flag here. What you can see is that Chipotle was starting to break out. It eventually did break out. Then it went sideways for several weeks until breaking out again. So it sort of made this flagging formation. Here's the flagpole, and then here's the flag itself. And the candlesticks demonstrate the range at which it traded in within that bull flag. But what's really important about these types of drawings is that it is in the eye of the beholder. Anyone who tells you otherwise is wrong. There is no exact science here. You have to be both an artist and a scientist, reading price, knowing how candlesticks work and the 4 points you have, and drawing it accordingly. You're also going to have to make a decision about how precise you want to be. Are your drawings only going to connect wicks? Are they going to connect bodies? Is it going to be a mixture of both? And make sure you practice and study that in great detail. Now, coming back to our line charts, what's really fascinating is that you can draw these levels on a candlestick chart and then switch to a line chart to sort of see how things change. And what's so interesting is the bull flag doesn't actually even get touched here because the line chart only shows one piece of information. It sort of deletes that extreme high, and it just will have you thinking a little differently about the drawings that you're doing. But it just highlights once again how important candlesticks are because you can see these extreme prices. So after this breakout here, you can see how high price got. That was the absolute extreme. That was the most willing buyer willing to buy Chipotle. And sure enough, when it broke out, look where the breakout occurred, right at that extreme price. So that wick had some very interesting information in it about how much people were willing to bid Chipotle up at that point in time, and perhaps even hold, because they just felt like, here's the earnings report, this had a great fundamental sound situation. So when you are using candlesticks to draw support and resistance lines, to draw trend lines, to draw chart patterns. Always remember you have those 4 key pieces of information: open, high, low, close, and you must be the person who determines for your own situation how you want to draw, measure, calculate, and then follow that specific drawing that you did based off of the open, high, low, and close. Find what works for you, back test it, make sure that you are getting some data about how you're performing. Don't take anything at face value, and spend some time not only mastering how you can read candlestick charts, but also now how you can draw on these candlestick charts with everything you've learned up until this point. If you are a new investor or trader, I think by now you are starting to see the effectiveness of candles or why they're used. And guess what? If you're a professional, you're a value investor, a fundamental investor, you're still watching, you still don't see the value, I think at this point, I'm really going to convince you that there's value here, because let's talk about how these candlesticks show sentiment. So check out this example of sentiment that I think you'll find in the markets often if you look closely enough, especially in stocks that are trending upward, but even more so in stocks that are trending downward. So on this chart, it's a daily chart. For example, there are only 7 green candles. That's right, only 7. Every other instance, every red candle on this chart means that price opened up here, so it started the day here, and ended down here. What does that tell you about how weak this stock was? There were just sellers every day. Price opened here, and all throughout the day, people were selling. And on only 7 occasions here, did price actually open down here and someone bought it up to a certain point. That tells you quite a bit about sentiment. Who's winning in this case? The bears, clearly. What do people think about this stock? Clearly no one cares, and clearly there's just more selling than buying, and you can even see that the price was going down until it became a sub $1 stock. So there's a lot of sentiment here that you can get from candles, and that is especially true because you can see the color of the candles. They are just red after red after red after red. On line charts or other candle chart or other chart types, you can't see that level of detail. Now, this of course is also true on the opposite side of things. Because, for example, let's go back to this chart of Chipotle. As you can see, Chipotle reported earnings right here, and they had a surprise earnings beat, which investors liked. And you can just see the level of green candles that happened after that earnings report and the trend that followed. In addition, in terms of sentiment, this is really interesting. Look at this candle right here, because what you see is a high that got quite high, a low that got quite low, but the open and close were not far off from each other. So it literally opened and closed at the same point, despite getting as high as here and as low as here. So there was indecision. Who was going to win? What was the true story of this earnings report? Well, by the next day and day after, the bulls just took control. There was clearly something more bullish here than people had seen the day after that report. And with candlesticks, you can get this level of information when analyzing the situation as such. Of course, we only know this part after the fact, but I would wager that if we saw this indecision and then saw this green candle the next day, and then saw this green candle the next day, well, I think there's some information here that's telling you there was a battle after earnings report. And the day after and the day after that, the bulls just simply pulled away. There were more buyers than sellers. There was strength. There were traders involved. There was something in that earnings report as well that may have attracted some big money. So this is another way candlesticks can be used to gauge sentiment, whether it's on the downside, like this example here, or on the upside after an earnings report. So whereas the sentiment example really dives into the component of seeing the different candlestick colors and whether it was a weak close or a downward trend, the supply and demand component comes in when you add volume to this. So you're getting another layer of data to add. How many buyers, how many sellers, in accordance with the direction of the candlestick or the chart itself. So a lot of people, or maybe on TikTok or other channels, for example, never bring up this aspect that In order to properly get a feel for supply and demand, you need to understand volume, because volume is what makes up the supply and demand curve. How many buyers are there? How many sellers are there? How many units of that particular thing are they trying to buy? That's how you measure supply and demand. A simple candlestick chart does not tell you supply and demand, but in accordance with volume, you can get some insights there. So similar to this sentiment example. So in this case, it's pretty clear to see what the sentiment is. Anyone who has watched even a part of this video can see what the sentiment is here. It's not good. No one likes the stock. There's lots of sellers, no buyers. It's going down. It's sub $1. Well, in this case, we can see multiple green candles. The story's a little different. There's a bullish trend here. This is super microcomputers, by the way. It was an AI play. And I've highlighted the volume zone as well. This is where supply and demand comes in. So we've got the reading on sentiment. We've got it that it's bullish, that there's buyers, that people are bidding this thing up. But look at the change now in volume. This is how you know that the demand has increased. This is how you know that there are more buyers than sellers. We have paired these candlesticks, these consecutive green candlesticks, with this surge in volume, and the move has now happened. It is occurring right here before our eyes. So we can use candlesticks to get a feel for sentiment, and then we can overlay volume to really see supply and demand and to get a feel for who's winning. Now, I like this example as well, by the way. Now I've zoomed in on super microcomputers, because we can see the volume is just increasing, right? These are the volume bars down here. And we can see green candle after green candle after green candle. And what's rather fun is you can read the candles to get a feel for the story. So on this day, the bulls won. Okay, the next day, the bulls won again. The next day, the bulls won again. They did it all on increasing volume, so there's more demand coming in. Next up, there is sort of a deciding battle here, because the open and the close are rather close. It got as low as this price point, as high as this price point. It wasn't a sort of deciding victory. So at that point, maybe you wait to the next day to see what happens. Look at the follow through. Absolutely ripped the next day. And by that point, the bulls had taken the castle. So I even write bulls take the castle. All of this is occurring in consecutive manner, green candle after green candle, with volume looking like a beautiful staircase, essentially, just increasing day after day. So this is the supply and demand component of candlesticks. I've spent a lot of time singing the praises of candlesticks, but getting back to the earlier part of my presentation, I do want to talk about the limitations again. Recall that there are no rich traders who trade candlesticks. Well, there are some out there. Also, there are people like myself. We have small accounts. I'm just trying to get an edge. Candlesticks do provide me with such information, so I utilize them. I'm not going to ever be a billionaire trader. It's just simply not going to happen. But I'm going to use candlesticks on my small-sized account. But I'm also going to use them with these limitations in mind. Specifically, nothing works 100% of the time. Anyone who tells you that candlesticks work 100% of the time, get away from them, block them, mute them, just don't listen to it. Markets are really difficult. It's impossible to win every single time. Just not possible. And with that, there are these limitations with candlesticks. Starting with that, they're simply too popular. Now, let's talk about the aspect that candlesticks have potentially been killed by their own discovery, meaning the more popular they get, the less edge there is. So edge is gone. If you have a winning method in markets and you share that method with the world, everyone's going to use that method. And now that method can no longer win because everyone's using it. In fact, taking the other side of that method is probably the better way because it's so crowded. Now, not everyone can get out in time. So it's just this crowded mess. That is where candlesticks have potentially run into, is they've gotten too popular. They've been killed by their own discovery. The edge is gone. And now add in the fact that a lot of the modern education around candlesticks is just terrible. I mean, it is just some of the worst things I've ever seen. And as mentioned earlier in my video, if I ran a high-powered trading group or hedge fund or algorithmic group, I would make an algorithm or a trading process that watched these videos on TikTok and just took the other side of these videos every single time. I mean, this video has 500,000 views, this one has 400,000 views, and they make it seem like trading candlesticks is really easy. Buy here, sell here, get rich. It does not work like that. It just simply doesn't. Candlesticks are often very noisy and simply have now been overused and overtaught to the point where they just are not going to win all the time. But ideally in this presentation, I've shown you some things that can get you started, that can teach you something new, that can give you different ways to utilize candlesticks. As mentioned, as my account is rather small, I think that candlesticks help me process information quickly with those 4 key data points. Speaking about candlesticks being noisy, they can give off too much information at times. And when there's too much information, there's lots of fake moves and thus no signal. And you can actually see that on a comparison of candlestick charts to line charts over long periods of time. Look how much smoother the line chart is. And it's one solid color. Now look at the candlestick charts. The moves are more exaggerated. There's red and green. The dips are really steep and deep. The highs are kind of euphoric, and you just don't see that on these charts. There's still a rather steep dip, but nowhere to the extent of this wick, and that smooths out the move a little bit. So over long periods of time, a line chart might truly be the better chart to use, and candlestick charts can sometimes be noisy, giving you lots of fake signals, lots of price action, almost too much to make an informed decision, and fake you out. And it just can be a challenging thing to read, especially for new traders and investors. So perhaps one of the things you want to do when getting started with candlesticks is just get started by practicing. Go open up a paper trading account and try some of these concepts that I have demonstrated throughout the presentation. Get a feel for the trading range. Get a feel for looking back at the abnormal moves to get a sense of what volatility could come. Set your expectations, usually using the open, high, low, and close. Figure out what type of range or volatility you're looking for and trade accordingly with your strategy. Know how to draw on the chart according with these specific candlesticks. Know how to set up trades or where to look for new trades based on the sentiment or just the general supply and demand of the candlesticks you're reading in accordance with volume. But now, most importantly, is to also know that you can sometimes get things wrong and nothing will work 100% of the time. So I want to show you this chart, which is going to outlay a signal error. So this is a chart of the S&P 500. You can see red candle here, red candle here, red, red. There's a little bit of green. Maybe with some hope. Another big red candle. Another big red candle. Well, this is getting rather bearish. I even wrote here market crash. The trend is down. The volume seems to be increasing, although there was sort of a decrease on this market crash day. And this can be really easy to misread. And this next chart actually shows you what happened afterward. So check this out. This is before. So let's say I'd placed a short trade here because of this candle. Well, look what happened after. Green, green, green. I mean, what a monster trend. What a massive fake out. And the point is that there are these signal errors. What you may think is a clear downward trend with bad sentiment, with increasing supply and less demand, and you have sort of set up your trade, maybe you've drawn a specific trend line based off of these candles, may very well turn out to be wrong. But that, once again, is really important because it does come back to something that I think is really key about this presentation that I don't believe a whole lot of people out there are teaching, and this needs to be said. It's all about setting your expectations. Knowing that nothing wins 100% of the time, knowing that you can measure the big abnormal moves and prepare for them, knowing that you can measure your ranges with the candlesticks, all gives you the power to plan out your trade accordingly so that if something does happen similar to this signal error, you're not just going to get absolutely crushed, because ideally you've done your research to get your expectations right, to know that this could happen. So when it does happen and it goes against you, say you had shorted here because the crash was coming, you just get out. You got a stop loss, you take your loss, you've done your research, you're like, this can happen. I've looked at this chart long enough. I've measured the moves. I can see the bulls win quite often. I know that they could definitely take this back. That is where candlesticks are key. You have to make sure you set your expectations, starting with knowing nothing works 100% of the time. But the most important part about this part of the presentation is understanding the limitations, which should help you Avoid getting crushed on trades like this. If you don't know the limitations, you may be the person who buys here because you think you've set everything up, you've watched all the videos, you've drawn all the trend lines, you've done all the research. The move goes against you. And now you're suddenly saying, I did everything correctly. There's no way it can go against it. It goes against you again and again and again and again until essentially the account just blows up or you can't do it any longer. But if you are setting your expectations properly by doing your research ahead of time, the whole point is to avoid such situations and just take a loss because you know it can happen. The candlesticks are showing you that it can happen. Now, another important thing about candlesticks is that they are often used incorrectly. So I want to really end this segment based off of making sure you know to check your settings, understand what it means to have a candlestick chart set to based on previous close or based on market open, and knowing your color scheme. Remember, green candles are green because they opened down here, closed up here. Red candles are red because they opened up here and closed down here. So I want to show some examples of this, by the way. So here's a chart, once again, of Chipotle. We right click and go to settings. You will find that there's often a feature that says color bars based on previous close. You can check this on or off. And what happens here with this feature is that it's going to color the bars based off of it if it closed higher than the previous close. So watch this candle right here. It's red, right? And the reason why it's red is because it opened here and closed here on that specific day. But if we color it based on the previous close, now this candle is green. The reason why this candle is green is that even though it closed below its open, it's still higher. It's still higher than the previous close. So it's still higher than the day before. So understanding this and these different nuances in your settings is key as you become a candlestick expert. Also, on the presentation slide here, I mentioned about your color scheme being messed up. Well, some traders actually don't realize that they can change the color of their bodies as needed, and sometimes they might be using a incorrect format. So they might accidentally change the green candles, no joke, to red, and the red candles to green, and that's really just going to throw you off. So make sure that your candles are set up accordingly, and even better, make sure you set up a candle that works for you. So here's an example. Maybe you actually don't want any colored candles, and you just want everything to be one solid color because all you're looking for is trend, but you still want to know the high and low and maybe some, mixed up example of open and close, but you could do that just by mastering your settings. But for the most part, making sure you understand how the bars are colored, whether it opened down here and closed up here, thus it's a green candle, or opened up here and closed down here, thus it's a red candle, or the settings and nuances you can have to color your candles, not based off of whether it was higher than the open, but if it was higher than the day before. So this is another key point of candlesticks. It's also listed as a limitation because a lot of people forget to check their settings and check these key details and that their color schemes are exactly correct. My goal with this presentation was to give away as much information as I possibly could so that people all over the planet can learn about the history of candlesticks, how they're used, and what they are. But also, at this point in time, I think it's important for everyone who still does not understand candlesticks or essentially why they're useful. I think you need to go back to the 1700s when they were first started. Now, that alone should blow a lot of people's minds. Candlesticks have been around since the 1700s. In fact, ancient rice traders in Sakata, Japan were using candlestick charts and were the first ones to develop candlestick charts to track the volatility and price action of rice in ancient Sakata, Japan. We have to give daps to the man who founded candlestick charts, Munehisa Homa. He is the gentleman who started to draw out these candlesticks on a piece of paper to track the high of the day, the low of the day, the open, and the close. And from there, the rest is history because Homa was using candlesticks to see where price was moving throughout the day so he can make more informed decisions. And Homa actually even wrote a book about candlestick patterns. So when you know something has lasted over many hundreds of years, first started in the 1700s, it's really hard to say that, hey, it must not be useful at all. This has stood the test of time. It gets tested time and time again, and it's still the most widely used chart type in history all over the planet, by the way, on different platforms for different assets. Now, candlesticks have evolved so much that they also now involve patterns. There are doji patterns, hammer patterns, engulfing patterns, and all of these patterns are being utilized to trade, follow markets, get a feel for sentiment, everything that has essentially been explained in this presentation. So what is rather interesting, though, to keep in mind about candlesticks is that while they were used in ancient Japan for many years, and were also used across just other asset classes in Japan as years went on, they really did not get introduced into the West until the late 1980s. So it's rather fascinating to keep in mind that candlesticks really got popular in the West in 1980s. So to some degree, they are still in their early days in terms of their usage, but at the same time, there's still some limitations and some aspects that we should know, and we should also be familiar with candlesticks' history to know where they came from and where they are today. So in the 1980s, Steve Nissen wrote Japanese Candlestick Charting Techniques. He really brought it mainstream. And down here, I've just drawn out some examples of candlesticks because one thing that I am going to make a course on next are all of the candlestick patterns in the market. I'm going to walk you through all of these different patterns so that you have a full playbook. The doji is one, the hammer is another, the gravestone is another, the bullish engulfing pattern is another. What you'll find is that traders have identified the looks of these candles and given them names based on their look. So if you see a candle that looks like this, it's a bullish hammer. It looks like someone's holding a hammer. This one's a gravestone. It kind of marks the end of a trend. It just looks rather deadly. It's a bearish gravestone candle. Candles have started to get these specific names based off of what they may be saying about buyers and sellers and what the history holds. Now, speaking of candlesticks one more time, and it does speak to their popularity, I've included this slide just to remind people that Coinbase has charts about candlesticks. That's right, Coinbase. This is a major cryptocurrency platform that has embraced candlestick charts. Then, of course, look at Connie Hill here in this Schwab presentation. Charles Schwab is a legacy trading firm. They are making videos about candlesticks as well. So it just spans all different investor and trader types, and that's important to know. You know the history of candlesticks, you know where they came from and how they've evolved, and especially now who's using them, because you want to know who you're trading against or investing with according to these candlesticks and just how many different asset classes they're now used in. So on that point, please keep in mind, in terms of candlestick patterns, that is going to be courses 2 and 3. So make sure you subscribe, and I will share those courses with you when they are live. Well, ladies and gentlemen, we have come to the end of the presentation, and now you're probably wondering, what is the conclusion of candlestick charts? And I think if you've stuck around this long, you know what the answer is. And the answer is as follows. Candlestick charts provide a ton of information that no other chart type can truly offer in such a concise and efficient way. More importantly, candlestick charts have tested time. Since the 1700s in ancient Japan, they have been used, and today they are one of the, if not the most popular chart on planet Earth. Thus, it is probably in your best interest to know how they work. You don't necessarily have to use them, but to be able to read them and utilize them will explain to you how many other traders are approaching markets. And after all, you might be trading against those people. You might be on the other side at times, thinking something different or taking the other trade. And to know how candlesticks work will give you that much more information into what they might be thinking or seeing. In addition, candlesticks show you those 4 key data points plus the color of the candle, the open, the high, the low, the close, in one quick view. And if you compare it to other chart types like the line chart, you just can't get that level of granular data anywhere else. And that data can help you set your expectations, measure out trading ranges, prepare for big moves, look for support and resistance and or chart patterns, gauge sentiment, and much, much more. So with that being said, candlestick charts are without a doubt one of the best chart types that can be utilized out there, whether you're an investor or trader. They work on all time frames, whether you're a short-term trader or a long-term investor. Now, there is one final key point here, though, that I have to say, and I just has to be reminded, nothing works 100% of the time. Be sure to test, test, test. Practice, practice, practice. Also, know the realities of markets. Anyone telling you that candlestick charts are a get-rich-quick scheme, just, like I said, block them, mute them, run, don't walk. This, ladies and gentlemen, is the first presentation that I've made on candlestick charts. As mentioned, I will have courses 2 and 3 on the way, and I believe that candlestick charts are still, to this day, since the 1700s, one of the most important chart types out there, and I hope this video helped you get started. If it did, please give me an upvote. Please be sure to subscribe, and also leave me a comment or two. That helps me. Thanks so much for watching.